Hey, Rick Elmendorf here, and in this video we're going to be discussing page 3 of the loan estimate. This is part 3 in a 3-part series called Keys to Understanding the Loan Estimate. For part 1 and part 2, the links will be in the description, so let's go ahead and get going. In page 3, you basically have a kind of summary of and some kind of house cleaning items, so to speak, that your lender must tell you about your loan. The CFPB encourages a comparison that the lender must give you, as well as some other considerations as to what your lender plans to do with your loan and other items as well. So let's jump right into those. So as far as comparisons go, this is actually pretty good. I mean, it's a nice little snapshot. What's going to happen? What is the state of this loan if I go through with it in 5 years? You know, how much interest am I going to pay, principal, mortgage insurance, the cost, all that added together is going to be a big number, you know, and that's a good number to be comparing. And most lenders, even though you're not going to be comparing multiple loan estimates, as I mentioned in part 2, it is a good number to compare, and your lender should be able to very easily calculate that. The other thing is where your principal will be in 5 years. In fact, more precisely, how much principal have you paid off in 5 years? So that's nice to know. The second thing is your annual percentage rate. Now, this was something I struggled with even understanding and being in the business for many, many years, but I'll break it down. Simply put, the APR is not your interest rate. It has to do with there are fees that are associated on your loan that get factored into the cost of your credit over the term of this loan. And that is why the interest rate that you're getting, the note rate, is typically lower than your annual percentage rate, because it has to do with the fees that are being assessed on your loan. And the last one here, I'm not even really sure what good this number is, but it's kind of a scary number, that your total interest percentage, the TIP, 69.45% in this scenario, and it represents the total amount of interest that you will pay over the loan term as a percentage of your loan amount. I'm not sure why that is even important, but it's there. Okay, some other considerations. Your appraisal. The only thing I would say here is that check if you actually need an appraisal. I know it says we may order an appraisal to determine the property's value, but there have been so many there's so many loans out there that don't require an appraisal. In fact, if the AUS or automated underwriting system may give you what's called a property inspection waiver. And I've seen lenders, and I've accidentally done it myself, where we got a property inspection waiver and we ordered an appraisal. Whoops. Well, guess what? If you don't need one, you don't need one. So make sure that you check with your lender to ensure that you do not need an appraisal. Assumption. This will tell you if your loan is assumable. Assumability kind of went by the wayside, and really only VA and FHA loans are assumable nowadays. Homeowners insurance, you have to have homeowners insurance. Late payments, and this is very, very typical. If your payment is more than 15 days late, then you get a late fee. Refinancing this loan will depend on your future financial situation. It's like, hey, basically, if you want to refinance, you got to qualify again. So there you go. Unless, again, it's a VA loan and there is really no qualifying to do, although rules may change. I've seen it happen. Anyway, servicing. And probably the most important thing is, does the lender intend to service your loan? I will tell you, most lenders do not service their loan, and you will typically see an X box in the we intend to transfer. Now, some lenders that subservice and most all lenders don't have an internal servicing team, but some companies actually service a loan, but they have a company, a third party, service it for them. So they still have to meet all the requirements of servicing. So they are technically the servicer or servicing the mortgage. So sometimes I've actually seen that box checked when it shouldn't be. And then, of course, you will get a notification after the loan closing saying your loan's been sold. So even if you see a checkbox saying we intend to service your loan, you may even get a letter from Fannie Mae or Freddie Mac saying, hey, congratulations, your loan just got sold to us. Well, guess what? All loans get sold, right? Because pools and mortgages get sold, but the servicing is retained. So this has to do with the servicing of your loan. So anyway, I hope this was helpful. That is page 3, and that does it for part 3, 1, 2, and 3. It's done. And I hope you found this enjoyable. If you did and it was valuable, please hit the like button and consider subscribing for more mortgage content. All right, take care. Have a wonderful day.